Bountiful City Council's working session, and
Is your mic on?
no, probably isn't, but it's probably good enough for right here. Yeah.
There you go.
Yeah. Okay, thanks. But anyway, welcome everyone, and for those who are here, well, let's hear an attendance. We'll start down there with you, Kate.
Kate Bradshaw.
Chris Simonson.
Kendall Harris.
Randy Lewis.
Richard Higginson, and also to my left shortly again, Millie Segura Barr.
Yeah, very good. And we'll turn time over to Tyson for our work session.
Actually, I'll start out.
Okay, thanks, Galen.
Thank you, Mayor and members of the council. One of the things that we do along with the budget process each year, particularly from a couple of years ago when we had a retreat and we talked about property tax and the importance that revenue source is to the city. The direction we received at that time was to relook at that every year and to see how things balance out between revenues and expenditures, which we do normally anyway, but to look at this most important source of revenue to us and then make recommendations to you based on what we're seeing there in trends and just things you need to be aware of. So we have a presentation tonight, which is part of our overall analysis. Just a little bit of well, it went too quick. A little bit of a primer for, there's not many of the public here, but a primer for the rest of you. On property tax, what it's utilized for. Property taxes, in Utah at least, are used for all the things that you depend on daily but kind of take for granted. Police services are behind the scenes things, information technology, finance and accounting, treasury, and our police, our public works, parks, maintenance, and all the things that we look forward to having as a member of a community. So those are the things that are taken care of by the property tax in part. Other things that go into the general fund, which all those services are funded from, include sales tax and utility franchise taxes, and then a variety of other things, including grants and so forth. But property tax is a very important source. Just to give you an idea, this property tax, just like every other revenue, and the expenses we pay are affected by inflation. And so if you look at just a span of years, 2011, $1,000 that year buys $1,000 worth of goods and services. But you take it to 2021, where we're at now, that same $1,000 isn't going to buy the same amount of goods and services if inflation increases, which it usually does. We have pretty low inflation, but even with that, $1,000 today will only buy $844 worth of goods and services. And so that's just an illustration of why we have to take a look at all of our revenues and balance it against expenses, because we have changes that come along, of which inflation is one that we need to be kind of mindful of. Now, just to review, this is from a couple of years ago, 2018 and 2019 retreats. We talked about property taxes in particular and the council's thoughts on the matter and their intents that came from that. And restated here are those intents, 5 of them. And just won't go through all of them there, just to let you take a look, but some of the highlights on them. To go through a process to evaluate property tax so that it's transparent, the citizens can see that we are being prudent with our evaluation of what revenues we have, what expenses we have, making sure that our revenue sources are considered before raising taxes, which we do every year, keeping the property tax revenues in particular caught up with inflation, which we just talked about. And then an intent that you express, which makes a great deal of sense, and that is that incremental increases are better than one large increase every 10, 20 years or whatever. It's just a little bit more understandable and just makes sense along the way. And then your direction to us, which we're doing tonight, is to report back to you annually about where we're at with the budgeting process and where we are with this important tax. So those are your intents from those years restated. Now, in support of those things, we have put together 3 points that kind of guide our efforts in recommending what to do with property tax and the budget overall to you each year. And one of those things is to provide protection against purchasing power, which we just talked about, which is inflation. capturing additional revenues in good years, that's from our sales tax, and protecting that with the other sources of revenue we have, which includes property tax. That's a hedge against future years, and part of our pay-as-you-go process, which is the third point, where we're trying to the extent possible, pay as you go rather than finance things with debt. Now, some things that we take a look at, these are just kind of a list of things that you could consider that you might need to change your revenue sources for to increase funding to take care of. And so a lot of these things are present right now. And so we are, it's a timely discussion. We have increasing service levels. We're adding new parks in the city. We're adding new services along the way, farmers market and other things. Increasing service levels, increasing levels of budget expenditures, exceeding the rate of inflation, declining sales tax revenues. That's an important discussion, which Tyson will get into here in just a minute. And then all the rest there, which there's several we could go through, but those are some of the top that are this year that have an impact upon our budget process. Here are a list of some of the new and enhanced programs that have come about in the last few years, and which are things that are brand new or have been changed substantially, and for which we need additional funding over and above our base, which we had before that time, to take care of. And so when you go through that list, it's a lot of good things that have been things that the community has desired, things which you have had on your priority list over the years. Creekside Park, which we're very proud of. Bountiful Town Square, of course, the same. Taking over the farmers market for at least a couple of years now, and the Washington Park property, which will be under development. And then the fiber to the home program and all those others that are listed there. Along with those, there's a price tag to maintaining those and putting them into play. And in particular with that, just the positions that are involved with some of those things. 3 of them impact the general fund, which is a tax-supported fund. 2 that are parks related, one that is the information technology department, which we've talked about in past meetings which we've had on the budget, which you've heard presentations on, to the tune of about $265,000 in new funds that are needed for supporting these initiatives, new programs that are listed. It wouldn't be appropriate to talk about property tax without seeing how we compare with others. And this is the most recent tax rate year we have, which is our 2020 calendar year tax rates. And all of the cities in Davis County that we have those rates displayed for, and what that means for an average home, which the assessor says in the most recent year is $402,136. So if you look at each of those communities, just their portion of the tax, not the whole tax bill, but just that city's portion of the bill, is just as stated there. As you'll notice, as Bountiful has continued to be over the years, we are the lowest. If you were to look at what that means, if, let's say we were to look at, and these last 2 bullet points on this slide tell the story best, I think. If we were to just take the next highest rate, if we were to have had our rate be that next highest rate, which is still very low, we would have brought in an additional $254,000 in 2020. And then if we would have just taken the average of the rates, and still would have been pretty low, we would have brought in an additional $1.9 million in property tax revenue that could be used for these projects, these ongoing things that we are establishing that are new programs, and to keep pace with inflation. So it's kind of a telling story when you see how over the years Bountiful's been very well managed financially and operationally to allow us to be able to survive, if you will, on not having to adjust the property tax very much.
I have a question, Galen, if
Yeah.
you don't mind.
You bet.
So when we look at, if a resident is looking at their tax bill and they see property tax, do you know what the percentage is? Is it like about 7% of what our city gets?
We are, you mean? Mm-hmm. The cities are go ahead.
Yes, Bountiful's property tax is about 7% of what somebody pays, a Bountiful resident pays for the total property tax, if that's what you're
Thank
asking.
you. Yeah, that's.
Yep.
And then, if I may, is this broken down annually or quarterly?
This is just
This-
this is the annual rate that,
the annual rate. Okay,
that a
thank you.
resident would pay. Yep. So when you consider all those services that we talked about on the first slide, in Bountiful's case, $161 is not a whole lot to pay for all the services they get. So a pretty good deal. And even at the average rates and the others we're talking about here, a really good deal when you consider what is paid for. Now Tyson is going to take over and talk about some more in-depth analysis.
Thirsty.
Mayor, members of the City Council, thank you for your time tonight. I do appreciate your efforts to do the responsibilities that not many people want to do, so thank you. Tonight, I wanted to, that's a little reverberating, I wanted to discuss some of the more in-depth financial information that we can look to help us know whether a property tax increase is needed. And so we're going to go into a bit of depth, and I hope I can keep your attention, but if at any point you have questions, let's stop and address them, and let's make sure we're all on the same page. And if I'm using any accounting jargon or financial jargon, just say, I don't understand what that means, so I'll try not to, but if I do. So at what point do we need to increase property taxes? There's many indicators, as Galen has mentioned, and a few things that we need to consider for sure is whenever we do increase a service level of the city that's funded through taxes, we have to consider a property tax increase. Our costs are increasing, we have to increase revenue to also match that level. So we also need to consider whether we're investing in capital improvements, parks or buildings or land, anything that would increase our maintenance footprint and require more operating costs of the city. That's another consideration on when we do a property tax increase. And then again, we need to look at our financial policies. You'll remember that in the budget document, every year we adopt a city council policies and priorities. And some of those policies and priorities are a pay-as-you-go financial policy, a balanced revenue source policy. And then also just this past fiscal year 2021, the council adopted a reserves policy. So we want to make sure that we keep a certain level of reserves in the city so that we can continue to operate in emergency situations and we can continue to operate as a pay-as-you-go entity. So that was adopted just this past fiscal year. So these are factors that we need to consider every time we look at the financial budget and say, is a property tax increase needed? So these are some of the major areas that we talk about. I wanted to just bring some dollar figures in and say, all right, over the past 5 fiscal years, what have we done from the Capital Projects Fund as far as projects go? So I'll let you go down this list, but in summary, we've used $27.4 million in the past 5 fiscal years of our Capital Projects Fund reserves. And I shouldn't say reserves, of our cash in the Capital Projects Fund. So we've spent a lot of late, and we've added 24.6 acres of park land to the city's footprint. So those are not small numbers. And along with that comes the responsibility to say, we've built it, we will maintain it, and we will make sure that it is a benefit to the city into the future. So we have to make sure that our finances are keeping up with our expenses so that we can maintain our property. So that's the capital side, and just a snapshot of what we've been looking at over the past 5 fiscal years. And I do want to stress that I'm not trying to identify those as bad projects. These are great projects, true gems for the city, but they have a price tag, and the building of it and the maintenance of it has a price tag. So what are some of the financial indicators that we've been looking at as city managers to say, all right, is a property tax increase needed? So number one, Galen's already touched on inflation, and we'll go into just a little bit more depth on that. Number two, are we being more operationally dependent on our sales tax dollars? Are we using more of our sales tax to operate than we are to build our capital projects or invest for the future? So on one-time costs versus ongoing costs there. And then how is our capital projects fund equity balance looking? So at the end of the day, do we have enough cash to continue to be a pay-as-you-go entity? So those are the three main areas we're going to take a little bit deeper dive into. So inflation. The general fund property taxes, back in fiscal year 2000, this is where this graph begins. And you can see this top blue line is our actual property tax. And so it reflects the exact dollars that we received in each of those fiscal years. The bottom orange line is that same level of property tax, only taking into consideration the inflation factor. And so over the past 20 years, we've actually lost $885,000 in buying power of our property tax. That's 33.5% of our purchasing power is lost due to inflation. Now, the city has done 2 property tax increases over the past 20 years. Once is this bump you can see in fiscal year 2001, and then the second was in fiscal year 2018 to 19. And I will say that neither of these property tax increases was due to inflation, to catch us back up. It was all due to increased service level that we had to compensate ourselves for in order to keep operating. So we've never actually done a property tax increase that compensates us for the loss of inflation, the buying power loss. Now, we've been lucky in the fact that our sales tax growth has, for the most part, kept up with this inflation. So we haven't had to raise property taxes due to sales tax growth and the blessing of having the power department at our disposal to help transfer money into the general fund and help offset some of these costs. So between those two factors, over the years, we haven't had to increase our property tax rates because we've had those two things in our favor. I will say that with our increased level of services over the past few years, the growth in sales tax is no longer sufficient to keep up with inflation. So we're seeing a downward trend in this, and our sales tax growth is no longer able to keep up with both our service level increase and the cost of inflation. So that's inflation. So the general fund, in order to talk about the next topic of operational dependency on sales tax, we need to talk about the general fund and its revenue sources. So it has 4 main revenue sources. We have sales tax, franchise tax, property tax, and then the light and power transfer. Those are the 4 main revenues for our general fund. And as you'll remember, the general fund does all of our services from parks to police to streets to plowing, all of those general fund purposes. That's where we get our revenue to fund those operations. Please, Mayor.
So Tyson, franchise taxes, tell us about some of those.
So franchise tax is, so on your cell phone, you have a monthly bill, and on your bill, you're going to see at the very bottom, you're going to have what they call franchise taxes. It's a certain dollar amount that the legislature allows us to charge on a cell phone bill that we then get a portion of that. So, and the same thing goes for natural gas and other broad services that are provided to the community that this legislature's allowed us to impose a slight tax on.
Mostly that have come from the outside.
Yeah.
Into the city.
Exactly. So it's these Questar Gas or Dominion Energy is collecting this on our behalf. They impose a tax on our behalf and they remit it to us.
That's good.
So that's what a franchise tax is, just in general terms. So we have control over 2 of these revenues. We have control over property tax and we have control over the light and power transfer. But sales tax, it is what it is. We get remitted from the tax commission, and there's nothing we can do about it. Same thing with the franchise tax. The legislature tells the entities exactly how much to charge, and they remit that to us. We have no control in those 2 arenas, and yet the general fund is extremely dependent on sales tax for our ongoing operations, as we'll discuss further. But so I wanted to highlight the fact that we can control 2 of the main revenue sources of the general fund. The Capital Projects Fund has only 1 main revenue source, and that is sales tax. And so in order to continue to fund our ongoing capital needs, we only have 1 revenue source, and that's sales tax. So we take our sales tax and we split it between the two funds, between the general fund and the capital projects fund. General fund is first, and we have to cover our operating needs. The payroll has to be made and bills have to be paid. So whatever sales tax the general fund uses, the excess then goes to the capital projects fund. And then in the capital projects fund, we either spend it on our current projects or we save it for the future projects. So we're splitting our sales tax between these two funds. So that's why I'm talking about the capital project fund sales tax when we're really considering property tax of the general fund. Because whatever revenue deficit we have in the general fund, we make up with sales tax dollars, which then in turn decreases the amount that we can deposit into the capital projects fund. So we're seeing a negative trend where more and more of our sales tax dollars are going to the general fund to cover operational costs than going into the capital projects fund. And that's a big concern because we're no longer saving for our projects into the future. And that's a trend that's been going on for quite some time, and we'll dig into a couple graphs there. So here, if we look back at fiscal year 2002, in this left side, we see that the capital project fund back in this fiscal year received 96% of our sales tax dollars, and the general fund only received 4%. So that's where we were back in 2002. Flash forward to what we're budgeting for fiscal year 2022, and we're spending 73% of our sales tax dollars in the general fund and 27% in the capital projects fund. So you can see that there is a huge swing from where we used to be. And it is because our service levels have been increasing, our costs have been increasing, and we've had to use sales tax dollars more and more just to operate, rather than to be able to save for our future capital investments. And really in fiscal year 2014 is when we saw, that was the first year that we saw that the general fund was using more sales tax dollars than the capital projects fund, and it's continued to escalate from there. So we're definitely seeing negative trends of not being able to use sales tax dollars for future purposes.
Tyson, I have a question.
Please.
For similarly situated cities, so like cities of the third class that would match up with us from a size perspective, and that would be maybe along the Wasatch Front, so they'd be similar. Do you have any idea what their mix of capital fund versus general fund is for sales tax? Do they look similar? Do they look different?
Yeah, it's a great question. I don't know the specifics there. One thing I do know is each city is just a little bit different in their sales tax dollars. Because, say for instance, Murray City is a very comparable city to Bountiful, but as far as population, I should say. But you look at their business and their retail, we're not even in the same ballpark. So the amount of sales tax dollars that they generate from businesses and from retail is far and above what we generate. So it's hard to draw an exact parallel, and I could run some numbers and try and see where we compare. Mm-hmm. One thing that is extremely telling that Galen highlighted already is just how low our property tax is in comparison to Davis County and the state in general. We didn't run the exact numbers, but we were in the very low percentile in property tax throughout the state. So the fact that we're so low in property tax and we've overcompensated with sales tax kind of leads me to believe that we're far more dependent on our sales tax dollars for operating costs than others might be. But again, I didn't run that data.
Okay, so, thanks.
Yeah.
Tyson, can I ask you a question? Just recently, we have Cal Ranch that has come to town, and I was in there. They're packing folks in there when I was there. How does the sales tax rank with like our supermarkets? I mean, what are the highest ones that bring us most of our sales tax coming in? What are they?
It's a great question. Smith's Marketplace is our almost always number one sales tax remitter. Our dealerships are then probably coming in 3, 4, 5. So we're very heavily dependent on sales tax from our marketplaces, our grocery stores and then Smiths. And then after that, it would be more the,
Online retailers are a big,
oh, thank
big
you.
component
Yes.
now as well.
Yep,
So Amazon's and Wayfair and, things of that nature.
yep. But Smith's Marketplace is always, almost always our number one remitter, so.
If we had another wonderful supermarket, that would again bring this up.
It does help, yeah. And just our number one remitter, Smiths, just to give you some context, they're in about the range of 20 to 30,000 per month of remittance to us. So it helps, but it doesn't solve all the issue. So we'd have to have multiple Smiths to come in and help correct this trend that we're seeing. So it's a great point, and I hope the best for Cal. I really do. I hope that they succeed famously and they bring in enormous amounts of sales tax to the city, but it would take multiple to really correct the trend that we're seeing. Great questions. Thank you for stopping me. So we know that we need to correct this negative trend that we're seeing, where we're dependent on our sales tax dollars to operate. We also need to continue to consider that as long as costs are rising, we have to raise our revenue streams to compensate. Otherwise, we know that we're in a deterioration of our financial status. So we do this for the utility funds regularly. So our enterprise funds, light and power, water, we analyze regularly how much we should be increasing the rates to cover our costs. We're pretty good about doing that. We haven't been as good about doing that with our general fund, which the two areas we can control is our property tax levy and our transfer from the light and power fund, and we have to be very careful with the transfer from light and power fund because we don't want to jeopardize their ability to continue to invest in their capital and their infrastructure moving forward. So we have to play a very balanced act there. So the capital project funds reserves are paying the price of our dependency on sales tax for operations. And I want to spend some time on some graphs, and I do apologize. I'm going to have a few graphs here for you. But so the capital project fund balance, and when I'm talking about fund balance, in simplified terms, this is the leftover cash reserves that we have from multiple years of our revenues exceeding our expenses. So if we have more revenue coming in than we have expenses going out, we save for a rainy day. And so our fund balance in the capital project fund is in essence our piggy bank, if you will, to then continue to operate and do capital projects into the future. So our fund balance, we're a pay-as-you-go entity, and that's our philosophy, is we want to pay as we go. So we're naturally going to see large swings in our fund balance. So when we have the good years, we're going to increase that fund balance, and then when we have big projects come up, we're going to spend that balance. And the trick is to make sure that we're in those years where we are not having large projects, we start to build back up those reserves and get us to the point where we can then, again, pay as we go and use our reserves to pay for these big projects as they come. So you can see that this blue line is showing us the fund balance over the years. In 2011, you can see that we had a drastic drop, and this is where the Capital Projects Fund actually transferred $10 million to the Light and Power Fund so that they didn't have to do additional bonding to build the power plant. So we've used the Capital Projects Fund over the years in many different ways. And so it really is our main financial tool that we use to keep ourselves pay as you go. So that we constantly are monitoring the fund balance of the Capital Project Fund because it is so crucial in keeping us as this pay as you go entity. Another thing that we consider is that asset life cycles are naturally going to ebb and flow. So our buildings age and our infrastructure ages, and so we have times when we'll spend a lot more and times when we won't. But what are we doing in those years when we don't have a lot of spending? Are we replenishing the fund balance like we should? So you can see that this trend is now on that downward slope. And what's concerning is that if we continue as projected for 2021 and for 2022 as budgeted, we'll end up at 19.7 million in fund balance for the capital projects fund, which is pre-2007 number. So we're getting extremely low in our reserves there. So same graph, and all I've done is just added this line. So you'll remember I talked about the reserve policy that we just adopted. This reserve policy dictates that we keep a $12 million reserve for emergency purposes, and it is to be used just for emergencies. We then have a capital reserve, which is basically a 10-year average of what we typically spend in capital projects out of this fund. So as of the end of 2020, fiscal year 2020, that number was 22.1 million. And that's what we say is our minimum balance that we need to maintain. So you can see that as budgeted, we're going to be dipping into that by 2.4 million in fiscal 2022. So again, just highlighting the fact that we're seeing our reserves deplete in the capital projects fund. And if we don't do something to correct that, we won't be able to have this financial tool, this necessary component of staying as a pay-as-you-go entity. So I ran some projections. So above and beyond what we've budgeted for in fiscal year 2022, what would it look like if we continue on without increasing property tax? Now, whenever you're projecting out into the future, there's a lot of assumptions you're making. And so here's just a few brief highlights of the assumptions. But just in general, if we look at where we're sitting in fiscal year 2020, then where we go to with estimated 2021, then budgeted 2022, and then using the assumptions that I input into this metric, we end up at around 12.4 million by the end of fiscal year 2026. This is assuming we don't do any property tax increase and don't change this negative trend that we're seeing. So it's very concerning, and you can see that we're far below that minimum reserve level that we're targeting to the tune of 10 million by fiscal year 2026. Now, again, projections. Who knows? If all of a sudden our roads last that much longer, we could see a benefit. If, however, our roads deteriorate faster and we need to do a bigger project, then again, so projections are an estimate, and so I don't want you to think that the sky is falling, but I do want to impress upon your minds that based off of the trends we're seeing, this is what the future could look like if we don't correct it. So recapping, the city, we've significantly increased our general fund service levels, as we've discussed, and in 2022 we're going to add 3 new positions. We've added all that park space that needs to be maintained. We've added all of the additional park equipment and space that is going to cost a lot of money to maintain and replace into the future. Our sales tax dollars are not covering the ground that they used to, and we've become increasingly dependent on them for just operating costs. And we're risking that ability to pay as we go, to keep ourselves debt-free as much as possible. And we've talked about all the significant investments that we've made in parks and in buildings, and we're seeing those reserves just continue to drop. So in summary, the city does need a property tax increase. It's not something that I or Galen or Gary have come to the conclusion on lightly, honestly. We're happy with the fact that we're the lowest property tax rate in Davis County. That's awesome. Love to keep it that way. But we do have to consider the fact that our financial indicators are showing us that it's time. We have to make a change. We have to reverse this negative trend we're seeing. Otherwise, we are going to find ourselves having to bond for more, having to pay those origination fees and interest costs. And as in our personal finances, the more we can stay debt-free, saving up every day for those future big expenses, the better off financially we're going to be. It's just good financial policy. So that's the bottom line, is we don't want to raise property taxes, but we're seeing these indicators that are showing us it's time. So what's next? So as management staff, we know we need to correct these trends. We've been seeing them for quite some time, and we know that they have to be corrected. So we're recommending that we raise property taxes in fiscal year 2022 and at the very latest fiscal year 2023. And then after that, we recommend that we maintain this course. We have to correct the ship and keep on course. And that is the key to our financial success. If we're going to continue to keep ourselves in this coveted status of pay-as-you-go, and it truly is a coveted status to be in the position we are, but we have to maintain the revenue streams to make that happen. So those are the management recommendations. So there's a lot that goes into these recommendations, and we're going to discuss this a little bit further. But before we continue, I want to understand your perspectives and your thoughts. Are you concerned about a property tax increase based off of the information that we've been discussing? Are there questions that you have about any one of those areas, whether it be inflation or the sales tax dependency or our increased service levels? Are there concerns about any of those before we continue on? Because the rest of the presentation is about how much we raise property tax and when, not if. So are there questions before I move on?
I have a question.
Please.
Do you have any charts about what our sales tax projections have looked like over the last little bit? I want to set aside 2020, 2021 as anomalies, but I am interested in what that growth trajectory has looked like.
In doing this analysis, I looked over the past 20 years of sales tax, and it increases about 3%. It's 3.12%, something like that, over this 20-year period. So historically, we're seeing 3% increases. That 3% increase is nowhere close to correcting this trend that we've been seeing.
Does it take I'm assuming it took a jump from what the growth percentage had been pre-Main Street Fairness to post-Main Street Fairness. Has that
Sorry,
changed
Main
that?
Street.
Online sales tax collection.
Oh, okay. Yeah, my bad. We have seen some uptick. I wouldn't say that it's been dramatic. Galen, any thoughts on that?
Well, when you're referring to that, you're referring to Nexus and being able to collect from online retailers. Yes, that sector has grown dramatically as a component. You know, we have the ones we've talked about before, our grocery stores, our bigger box retailers, car dealerships, and so forth. But online retailers are a big component now.
It's a little challenging to calculate that because the same year that we were able to start collecting online sales, we lost a grocery store. That's when the second Smiths went to Woods Cross. We were projecting a pretty big loss in sales tax, and we ended up seeing, I think, a 2% increase that year. Largely, we believe, because of the offsetting revenue from online sales.
And just this particular year we're in has been kind of unique depending on where you're situated, what type of community you are. If you're a resort community, you've been hit significantly because of lack of food purchases, hotels, and so forth. But in a community such as us, we've actually seen some pretty good upticks in which will not continue. It'll be more along the lines of the 3% when you look at it trending over a number of years. But this year has actually been pretty good.
Yeah, I would agree, just based on the number of boxes that show up at my house daily.
If it's not too much trouble, could we go back to the slide that showed all of the cities and our position compared to other cities in Davis County? Just so I can have that in my brain for as we chat moving forward.
Could you send us these slides
Yes, please.
as well, if you would send
Absolutely,
those
yeah.
out to us, we'd appreciate it.
I want to thank Millie for asking for that slide because I was going to feel bad asking for it when I should be asking for more charts and graphs about city budget. But that's the really important one.
It is important, it really is.
And the numbers, oh, there it is at the bottom. So Centerville's the highest. Am I interpreting that correctly? I mean, it's that straightforward, correct?
Probably be Fruit Heights is the highest. If you look over on the right, they're just
Well, I'm
listed.
going on the right, excuse me, they're just listed alphabetically.
Yeah.
So is a $402,000 home the average home in the county? Or, because that's not, I thought our
Correct.
average home, based
Yep.
on our bond stuff last year, was like 350.
Yeah, so the assessor's office at least has shown that as the average.
And the figure you use, if you're going to do a truth and taxation hearing, the figure you use is the average home within the community. They do calculate that slightly different. This figure is off of the assessor's 2020 report throughout the county, and this is the number they gave us for every single family residential type home averaged out. So this number will be pretty close, but it could differ a little bit when you do a truth and taxation hearing if you go that route. It'll be pretty close.
Okay, other questions before we continue on to how much and when? I definitely want to make sure that we're all feeling comfortable that the financial indicators show us that it's time. But please, Richard.
We should probably say too that the federal government can't continue to just print fake money without impacting us significantly inflation-wise. So the inflation that we've suffered thus far has happened in a more realistic economy than we're in now. So I fear that curve is going to turn against us more as well.
That's a great point. Okay, so now on to how much and when. the unfortunate fun part of our discussion. So in determining how much, what I wanted to do is go back and say, all right, in our capital project fund, how much do we on average spend over any given time frame? So I went back over the last 14 fiscal years, and you can see the blue line is the actual amounts that we've spent. So you can see it's all over the board. But if we average that out, we're looking at about 4.49 million in average capital project fund expenditures. So that's kind of where I started, is saying, all right, we know our expenses, we know how much we're paying out on average. Then we have to compensate that with a revenue stream of about that amount just to stay flat, just to keep pace. Or if we want to start to build back up, we have to increase our revenue above this number. Please. Yep.
So the $22.1 million threshold was established by what criteria? Wasn't it 10 years of expenditures?
Exactly, a rolling average of 10 years capital project expenditures.
Two
then
years. So it
Was it-
was an average of 2 years expenditures averaged over 10 years. So
Right. Yep.
so it's 12 million plus 2 times 4.5.
Okay. Thank you.
Thank you for the clarification, Gary.
The enterprise funds, we said 1 year.
1 year.
But,
yeah.
but because of the nature of this, we said 2 years.
Perfect. Thank you for the clarification.
So that's what we're spending on average out of the capital projects fund. So then what are we getting in revenue stream? So this is a busy graph, and I apologize for it, but the orange line that we're seeing here is our sales tax revenue. As I mentioned, this is our main revenue source for the capital projects fund, and again, you can see that it is kind of all over the board, based off of how much we need to use in the general fund. So, but on average, the average amount of revenue stream that we're getting into the capital projects fund is this 3.9 million figure. So the upper line here, this green line, is our average expenditures, and then the blue line is our average sales tax revenue. And here in the middle, I've just shown the gap. We can see that our revenue stream is coming in substantially less than our expenses going out. So we're at the tune of $550,000 in gap, that if we don't correct this trend, we will never gain ground in the capital projects fund. So that $550,000 gap is an important figure that we'll address further on. So how much do we increase it? If we look at the 3 new positions that we're proposing for fiscal 2022, that $265,000, and then we remove that gap between our revenue and our expense, that brings us to a total of $815,000. And this is what's necessary to get us to the point where we've reversed that trend. I wouldn't say that it's to the point where we're actually really gaining ground in the capital projects fund, but it does reverse that trend and makes it so that we can start putting more of our sales tax dollars into the capital projects fund for future investment. So $815,000 is that dollar figure that we need to increase in order to reverse this trend. Now, what is that in a percentage? From our 2020 tax year, that would be a 31.58% increase, and that's just an estimate because we don't know the exact numbers based off, because the county has not created the assessment yet for our upcoming calendar year. So that's an estimate, and then again, what would that look like to the average homeowner? On an average home, it would increase their property tax $50.84. That's an estimate again, but that's $4.24 a month. So we are talking about a fairly substantial increase. When Bountiful's only done 2 property tax increases in the past 20 years, and now we're talking about a substantial increase like this, again, we did not come to this conclusion lightly. It's something that based off of the data that we're seeing, we feel is a necessary amount. So that's the discussion of how much. So you'll remember I projected out what it would look like if we did not increase property tax and where our capital project fund reserves would end if we did not do anything. And we would be about $10 million below our minimum reserve level. If we were to do a property tax increase of $815,000 in fiscal year 2022 and then do 2% annual increases just to keep up with inflation, this is what this graph is showing us. So we know that we're going to dip down in 2021 and 2022 into our reserves. That's a normal ebb and flow of the capital project fund, but we need to replenish. And if we do these increases, you can see by the end of fiscal year 2026, we've gotten back above that minimum threshold that we need. So instead of a trend that continually takes us down, we've got a trend that's starting to get us back to where we need to be. So it is a significant one-time correction, but one that is needed. And based off of all the financial data that we've looked at, these indicators are showing this is what we need. So that would bring us back to our policy, and so that's management's recommendation. I know it doesn't. It's not an easy decision to make, but we're recommending that in our 2022 budget we do increase property taxes by the $815,000, and then annually afterwards we do inflationary adjustments, and we have to keep ourselves in that path that will continue our financial stability and this pay-as-you-go opportunity that we find ourselves in. So now I'm going to turn it to you, and love to get your thoughts and your considerations on this. And then just something to be aware of, we don't have to make a decision tonight on this, but if we're going to raise property taxes in fiscal year 2022, we do need to know that by our city council meeting on the 8th of June. That way we can let the Davis County Assessor's Office know our intent to increase it, and we can include it in the budget document that you'll approve, at least tentatively, on the 22nd. So I'm turning it back to you, and we're all happy to answer any questions that you have.
Thank you, Tyson. I appreciate your work and your analysis. You know, it just makes sense. It's not pleasant, but when you look at the things that we do, employees that we pay, the costs of goods the supplies and materials that we need to run our city, those things are going up in price, and it just makes sense that we have to compensate for that. So I really appreciate your work.
Oh, no, go ahead.
I think for me, the big indicator is the amount of acreage we've increased in our city's portfolio. And I think that's just a wonderful boon to our community. And I think to be able to maintain it the way it needs to be maintained, and that we're not constantly playing catch up, I think it will just be like Councilwoman Harris said, it's not necessarily a nice thing, or it's a hard pill to swallow, but I think the long-term effects will be felt for generations. So that's my 2 cents.
That's good. I was going to say that the Utah Foundation rates Bountiful as in the county #1 for quality of life. We only maintain that quality of life by making these kind of wise decisions that have to be done.
What else do you need?
So if the council is interested in actually firming up a decision tonight, we can do that. Or if you need more information, if we want to come back, spend more time on any part of the presentation, happy to do that. Happy to do more research if it's going to help in the decision process. We really just need to know, are we committed to increasing taxes? How much and when? And
Here's my thought, if I could. We've talked about standing behind the extra burden we've put on the city in increasing our park space, et cetera, and I'm committed to doing that. I'd like to hear what the impact would be if we as a council decided that we were going to raise property taxes 15% each of the next 3 years, rather than increasing it 30%, over 30% this year, and then 2% annually. If we ramp up to that catching up process, it also gives us a chance to look back each year, see what the accuracy of our projections are, see how the city is financially, see where we're going in our balances, and make adjustments as necessary. So I think for me, I'd be more comfortable with that slower approach, understanding that I'm still committed to getting us back to where we need to be, purchase power-wise, fund balance-wise, et cetera. But if it's not too much work, I'd love to see what the projections might look like if we scheduled incremental rather than just one big one and then,
yeah,
so,
that's always an option.
Are you making that into a motion?
no. I think that more discussion another time would be great with a little more data, but I'm happy to participate in a motion. But just an idea for further discussion at a different time.
I think my thoughts align with Councilman Higginson's, that I'd like to see something in a phased approach. I'd like to spend a little more time on sales tax charts and growth patterns, and realistic growth patterns outside of the 2020 and 2021 anomaly there, and what we think is that sustainable sales tax percentage that we would shift to capital projects if we think that what were we at, 24% of sales tax going to the capital projects funds versus.
Oh, right, in
if-
fiscal
does it-
2022.
Yeah, does it need, I mean, what is sustainable from a sales tax perspective? Does it need to be 38% or 40%, or does it need to be 50?
It's more in the line of 50, yeah.
So I'd like to spend a little more time on it. And I think it's an important enough decision that it would, maybe warrant the next work session as well.
Anybody feel any differently than that?
No, I think
I think that's good. Just a reminder that if anything's going to happen this year, it has to happen by June the 8th. So we have to be diligent about what we're looking at.
And may I say again,
Sure.
if it needs to happen the way you've presented it, I'm on board. If there are options that give us a chance to, like I say, to take looks back and reevaluate and see where the numbers are really coming in, I think that's a great option too. So not turning to jelly on you, Tyson.
Well, thank you, Rich. And the fact is that by this pattern, we would be a little bit ahead of where we would be otherwise. So So I think that's attractive. So do you have your answer?
I think we're
Answer?
good. So specifically, we're looking to do probably another work session to discuss detailed items that you'd like to look at more in depth. We've talked about the sales tax, additional
this.
options for curving out that increase. Anything else that you'd like to see brought back?
I think that's good.
Treats.
Thank you. Treats, yeah.
I can
Mayor,
deliver.
Mayor, I
Yeah.
just think, going along with Richard, a smaller pill each year to swallow is a lot easier than one great big one.
Indeed.
So I like the idea of moving it along the lower level.
Sounds great.
Thank you, Tyson.
Thank you. Thank
We
you for your
appreciate it,
time.
and thank you, Galen. Thank you for, that's a great presentation and one that simplifies things to my IQ. Thank you.
All of ours.
We will take like 2 or 3 minutes of break for those who need it, and then we will begin.